Brought to you by the Northward Center.
Welcome to New Jersey Capital Report. I'm Rafael P. Roman.
And I'm Steve Adubato. We are welcoming back our good friend Gerald Lipkin, Chairman, President, Chief Executive Officer of Valley National Bank. Talk about everything going on in the banking world. Wow. Jerry, do us a favor. Jerry, the footprint of Valley is?
New York, New Jersey, and Florida.
That's right, Florida. Jerry, this is a late starter subject. The situation in England as we're doing this program going into July. Voters decide, hey, we're out of the European Union. It means what to us in the United States?
Economically.
Economically.
I think it's a topic that's somewhat overblown because nobody really knows exactly how it's going to affect everybody in the United States. They haven't settled with the European Union on pulling out. They haven't even officially applied to pull out.
And once they do, it's a long divorce.
Right. And we don't even know for what areas they'll still remain. Will they still have free travel between the European Union countries and themselves? Yeah. The stock market just went crazy over the news. They say they were shocked and surprised. I was over in England a couple of weeks ago, and it was too close to call when you turned on the TV in England. Well, if something is too close to call, it's kind of hard to believe that you were shocked and surprised.
Yeah. Right.
Yeah.
It was not an overwhelming shift in thought.
Right. But the fundamentals of the economy of Europe or of England hasn't changed at all because of this.
Correct.
So this is a passing thing, you think?
The
stock market plummet?
I think when the dust settles, they're going to work out a lot of compromises between the European Union and England. And when that all happens, I think we'll all have a better feel. I think people running for the doors, it's just a panic at this
We'll
point.
monitor the situation. As I said, we're doing this program as we go into July of 2016. Jerry, let's talk about regulation, okay, the banking environment. As this presidential campaign moves forward, there's going to be some talk about bank regulation. Do this for us. Clarify the difference between an investment bank and a community bank first before we talk about regulation.
Okay. Valley is a community bank. We deal one-on-one with our local clients. We finance small projects. We finance home acquisitions. We finance purchases of automobiles. We do the type of financing that most people on the street would think of when they talk about a bank. Yeah. An investment bank is totally different. They are the mega banks. They fund new corporations. They help capitalize them. They raise money on the street in various ways. They create investment vehicles for people to invest in. They created the subprime mortgage-backed securities that created so much havoc. The commercial banks, the regional banks, the guy who has the office on First and Main, the Valley National Banks of the world, did none of that.
So what about the whole regulatory situation, Dodd-Frank, that comes out of that?
Just like everything else that seems to come out of Washington, they go after the ant with a sledgehammer.
Is that what it is?
Yes. I mean, they put regulations now. I'm not suggesting that it wasn't appropriate to put regulations on some of the larger investment banks, but they put those same regulations on everybody. They went down to banks of $10 billion in size, and now $10 billion may sound like a lot of money. In the banking world, that doesn't certainly control the banks, and the mega banks, the top 5, are hundreds of times larger than that.
What's the problem with that? Because the Congress members that we talked to, Dodd-Frank is simply just a name of the 2 members of Congress, Barney Frank and Chris Dodd, Senator Dodd from Connecticut. They were the names of the legislators who were involved in this legislation that were supposed to say, listen, we're trying to avoid what happened in the meltdown, if you will, and we're going to put regulations on the banks so they wouldn't make these bad loans. You say the outcome of that, in some ways...
Well, it was negative because it placed enormous costs and burdens on your local community bank.
How so? Give us an example.
Well, we have to comply with the FAST, which is a program that that predicts what the bank would do under the most adverse situations, what we would look like under the most adverse situations.
Isn't that a good thing?
Well, considering that we have 100 people working, I don't know how many hundreds of hours to put this thing together, we have a stack of paper that if I were sitting at the table, it would be this high.
You mean compliance?
Yes.
Yeah.
And tell me what it proves. We pass it every year.
But from what I've read, the investment banks have been thwarted in the degree of risky investments that they can make as a result of.
I said it applied to a handful of investment banks. It may apply to a handful of very, very large commercial banks. But once you get past the 15th largest bank in the country, the difference in size becomes enormous. But and we're required to do all this work.
One of the things that Dodd-Frank was supposed to do was to stop the situation where banks became too big to fail.
Right.
But from what I've been reading, preparing for this interview, there's been, as a result of Dodd-Frank and other regulations, there's been consolidation of banks, mergers of banks. So they seem to be getting bigger.
When I started out in banking, there were approximately 20,000 banks in the United States. When the crisis hit in 2008, and that is some 40 years after I started, the number of banks in the United States had shrunk to approximately 8,400.
Wow.
And by the way, the American Bankers Association believes that less than 400 of those 8,400 ever made a subprime loan. All right? Now, today, we're approximately 5,700, and that number keeps shrinking rapidly.
Is that a good thing?
Well, in some ways it's a good thing. In some ways it's not a good thing. It's not really a good thing to the consumer because he has fewer choices.
Right.
There's less of a interpersonal relationship between the small business person and their banker.
Because there are fewer banks. Let's do this. And to disclose, I know an awful lot about your bank because I've done a whole range of leadership development at Valley, and I know your operation pretty well. And one of the things I want to talk about here and help people understand this, interest rates. Let's talk about the Fed, the fact that the Fed has opted not to lower interest rates. What has been the impact from your perspective, Jerry, on the consumer, and what options are there for consumers in terms of home buying, car buying, whatever?
And for the banks.
It's a dual-edged sword. Interest rates have been pushed to artificially low rates.
Why artificially?
Because on their own, they would never go down to practically zero. And right now, we're bouncing on the floor of zero.
For a long time now.
For a long time. And they've been held down for a very long time. That negatively impacts banks like Valley, who make their income not by investment products, but we make the bulk of our income on the difference between what we pay our depositors and what we charge our borrowers. That's our net interest. And that's the number that's so critical. That number has been compressed because of the low interest rates. What we pay our depositors has gone to practically zero. All right? But what we charge our borrowers has come down dramatically. That keeps coming down. You can't go below zero on what you pay your depositors, so that causes an interest rate compression. That's really very difficult for what was known as a spread bank like Valley to make a lot of money. It makes it very difficult to make money.
Hard to make loans? Harder?
It's harder to make loans because you have less tolerance for risk. Because if you make a mistake, you have a smaller margin to fall back on. But there is an opportunity.
For what?
For homeowners.
Yeah.
That has been a great opportunity.
So that's been good for you, too.
It's been good for Valley. We have been doing an enormous amount of home refinancing over the last 7, 8 years.
Because of the rates?
Because of the rates.
So overall, low interest rates has not helped the banks. Overall.
Correct.
Regulations have certainly not helped the bank. How is the banking industry doing? How does it compare today to what it was in, let's say, 2007, before the Great Recession?
Well, the good news is that loan losses are very, very low. And as a result of that, we're absorbing some of the compression that the bank is facing because of the low interest rates. We are offsetting that by the fact that we have lower loan losses. The lower loan losses are a result of more cautious lending. Now, more cautious lending is not necessarily bad, but it becomes extremely cautious when you have a razor-thin profit margin. So a lot of people who could have borrowed money in the past are finding it more difficult to get the funds today.
Which hurts the economy because people are not expanding their businesses. They're not making purchases because they're not getting access to capital. And that's the impact on the economy.
Correct.
Before I let you go, Jerry, real quick, bullish on the banking industry as you move forward?
Absolutely.
Because?
Absolutely. Well, banks are really the grease that the gears need to turn the economy, to grow the economy, and we're going to be here.
Gotcha. Jerry Lipkin, who is the chairman, president, and CEO of Valley National Bank. Appreciate you joining us and talking everything about the banking industry. Appreciate it.
Brought to you by the Northward Center, Holy Name Medical Center in Teaneck, New Jersey, the Give Something Back Foundation, and by ShopRite Supermarkets.